Hello, everyone, and let's come back to our discussion on 7 different time series method, forecasting method for doing the time series analysis. Last notebook, we reviewed the so-called BitCoin to US dollar type of thing, and we review since 2020 we start teaching the subject, and the price of Bitcoin went from $8,600 all the way to $120,000 in 2025. Okay, and before we're doing anything with Bitcoin, last lecture we have, and we reviewed 7 different time series analysis and forecasting method, including the naive approach, basically using the previous data as the next forecast. Second is a simple average. I'm taking the average of previous data using as the forecast. The method 3, we illustrate the moving average. We're using these 3 methods as our baseline comparison, which means they're simple, they're easy to implement, and we use them as see if we can improve our forecast. The 4th method we'll use is the simple exponential smoothing method. Then, simple exponential smoothing, we know that it's only forecasting the level of the your historical data. Then we move on to the exponential smoothing with a linear trend, and this is referred as a Holt method. Okay, so now we can deal with the trend and the level of the forecast. Method number 6 we reviewed, we used the so-called Holt-Winters methods, a seasonal pattern. So now we're including the consideration of the seasonality information. Finally, we ended the last lecture period by using a so-called autoregression integrated moving average method, stands for ARIMA method. Okay, is a statistic method we introduce. We're basically using a Kager's competition data set called JetRail. It's a fast trend as a data set to walk you through all these 7 methods. From the result we're getting from last time and what we have, let's go over to I'm going to continue on these, and these are the data set. We split it the data into training data set in blue and the testing data set in orange. So I'm using the blue color data to build a model, and then use the test data set to validate if the model forecast is accurate. The last 2 methods we use, we keep scrolling down to the last portion. You can notice that this method and the data shows very significant seasonality patterns and also a trend pattern, uptrend patterns. So the data actually starts low, go up high. So there is a significant linear trends going on. And also the seasonality pattern can be recognized by the triple exponential smoothing, which is a Holt-Winters method. And the green line represents the forecast using the triple exponential smoothing method, and actually forecast quite accurately. From last time, we also did a ARIMA, we call it SARI-MAX model as well. and also have a very good prediction on the seasonality patterns of the data. Compared to their room mean square error, compared to the, for example, the Holt-Winters method is about 27.5, and the room mean square error for ARIMA is about 26. So these two methods I'm using for the data has a significant trend and the seasonal patterns type of data, as the example we use so far, are fairly compatible, and they're both pretty good. So now we move on to the new data set we're going to use today. We're going to apply these two methods, which we know so far the best, to the BitCoin to USD prices. Here I have downloaded the BitCoin data from all the way to, I think it's from 2014. I cut it off. 2014, September 17, all the way to 2026, February 21st. Okay, so here we have a 4,178 data point right here. So we're going to use this data set for today's illustration. Let's see how well our methods works on these particular data. Let's see if we can also extend this application to other stock prices or asset prices as well. So here we're using plotting the whole thing since 2014, okay, all the way to February of 2026. And over here, it reaches about 120,000 to the top. And finally, for the past few weeks, it drops significantly. So the data itself and the pricing of the Bitcoin has been very volatile in the past few months. Let's see if our method actually can capture these trends, uptrend and downtrend, using the forecast method we have. All right. So these are the data set we have, okay, and the raw data set for each day since 2014, September 17, day, open price, high price, low price, close, and adjust the close, and so on, and the volume. And I'm using timestamp, converted day into timestamp, and I convert back into index for that. Okay. So the last data point is 2026, February 21st. As about last week when we presented. And then we're going to drop all the newer data, which we have 4,177. So we drop one of the data. And we'll do a seasonal decomposition plot from using the stats models API and perform a seasonal decomposition. We see that the first subgraph is the original, the raw data. The second one is the trend data. The third subgraph is the seasonal pattern. We see that there is clearly a seasonal patterns on the Bitcoin data. Finally, we're going to like to see the residual data after we take out the trend and the seasonal pattern. We see that still the data is not exactly random. It also shows this, another seasonal patterns within. Okay. So here we know that the seasonal pattern itself has a certain delay as well for that purpose. So it's not exactly normal randoms in this case. Okay. So probably this data has additional seasonal pattern we cannot capture using the seasonal decomposition. We see if our model can catch those type of grasp these trend. For the sake of easy to present, I'm going to use only the 1 year worth of data from 2025 to all the way to end of the January 2026 as the data, training data to build a model. And I'm going to use the rest of the data set from February 1st all the way to 21st as the validation so we can forecast that. So keep it simple. We using the monthly data we have for 13 months basically and to forecast the final 21 days. So this is how I separate our training models and our training data set and testing data set. So from January 1st, 2025 to January 31st of 2026, we use that as a training data set. All right. And testing data set is from February 1st of 2026 and on. And we copy those into train and test. Simply, we run the SARIMAX model. Okay, these are the optimal parameter I find. Perform the forecast. Okay, I ignore the in the sample prediction for the training data, so we can quickly to save some space for the graph part. So here we're going to plot the SARIMAX result. You can see that. After that, the blue portion is the training data, and the orange portion is the testing data. You see that there is a significantly downtrend and very volatile in the past few weeks. And you see the SARIMAX model prediction actually capture fairly well. Okay. Let's just see. Okay, I know for the previous example, the jet rails example, the Holt-Winters method also works pretty good. Let's see if that works. So I'm going to using the Holt-Winters method to do it again. And you see that the result of the Holt-Winters method, this is the fit number 2. And I superimpose the both forecasts together. The red portion is the Holt-Winters method. And then the purple line is the forecast from the ARIMA model, ARIMA model. Okay. But just visualize the forecast data against the test data. It looks like this ARIMA models do a slightly better jobs on capture the downtrends in the very last month or so. And that's using some formal so-called performance matrix and to evaluate it. Here I listed 4. So I'm using the rule mean square error, mean absolute error, mean absolute percentage errors, and the R-squared score to compare both methods. So here I have the SARIMAX models and the Holt-Winters method printed out the result. You see that actually the SARIMAX model gives better rule mean square errors and overall better performance. Okay, so 4,500 compared to 8,800 in the root mean square arrow. Review the data set again. This is the original data set I had. And these are the forecasts for the Saramax model and Holt-Winters method. So far, there's no too much of a surprise. His method, I think the Saramax method is a little bit better. So now we can see if we can improve this even further. Okay. So what I usually do for the stock prices or asset prices, such a volatile price, is the common practice to do the data transform. The data transform actually in the financial sector are usually frequently using as a so-called log of the return. So first we're using the price return transformation for the forecast. Okay, you see that. The return is actually the ratio between the change of the stock price and divided by the previous price, which is, we asked you to calculate this in our homework before. And then we'll take a natural log of these prices, okay, and this is the log of the return. We call the log of a return. After we compare these, we can see that the log of a return looks like this. It's much simpler, stable. There's a take out the trend, but seasonal pattern is still there. So as opposed to the original data you see, and they are in the 120,000 to a couple thousand. Now you take a natural log of the changes. Oh, this is within 1 to negative 0.1. Okay, positive 0.1 to negative 0.1. So it's much more manageable range instead of the highly volatile. And also the trend information got took out and only leave the seasonal pattern. So hypothetically, we want to do this is we can convert a non-stationary data into a stationary data set. Okay. Just doing this, we don't know how good it is. So we see if we can apply directly to these natural log of the return using that as a forecast tool. So here is the raw data as is a log of return. I'm running through a Saramax model again, and these are the optimal parameter I find. Okay, the result. So now we look at the forecast result. So these are the trending data in blue. Orange data is the testing data we use to validate a model. And the purple line represents the forecast for using the Saramax model. You see that it captured the up and down quite good, but not at the magnitude is not there. So we don't know how good it is since this is a transformed data from the log of the return. And you can also notice that the data is ranging from a couple thousand to originally ranged from a couple thousand to 120,000. Now it's ranging from 0.1 to the negative 0.1, so in that range. And we also noticed that the past month also we have very volatile up and downs in our curve. So we would like to see how good after the data transform, is that worth the trouble or not? And then after we perform the forecast, and like usual, we can have to convert it back to the original scale. Okay, so we're taking, this is a small subroutine I come up to convert the entire data to the reconstructor or original data. These are the forecast data I have. Okay, from the log transform the return and convert back to the original scale. So let's see how good this thing does. This thing also captured quite a bit of the original downtrend using ARIMA model, SARIMAX model, basically. And we will see that how good it is in terms of these performance matrices what we have. So here it captured the downtrend, but not the volatility and the last part. And we calculate the mean squared error, absolute errors, and absolute percentage error, and the R-squared. There's about 3,900 compared to the one before. We have about 46, I guess. Let me see. Yeah, that's about 4,600s and 8,800s. But now for the log transform model, it's around 40. So this is very compatible to a slightly improvement from the previous non-scaled data. Usually they're using the log scaled data usually produce much better, more stable forecast result. In this case, the data is extremely volatile, still performs very well. I would say compatible well. I just show you some of the common practice we use for analyze financial data and complicated forecast data. The method we used before are very much accurate, quite accurate for the data set with a clear trending linear trend and a clear seasonal pattern. They perform real well. But for the volatile data like this, like a BitCoin and this the SARIMAX model actually still perform very well. And my question for you is, if we can, using the similar approach for other stock, like more stable company stock data, like a Micron Technology or Tesla, and are they actually giving you a good forecast? All right, so we'll continue on this line of discussion in the next few Jupyter Notebook. I'm showing you some of the forecasting technique can be easily applied, and other type of forecast method as well will be applying to doing forecasts in the financial sector. Hopefully in the end of the semester, we can introduce some of the sophisticated neural network, deep learning algorithm to do the same thing. Okay. I'm going to conclude today's lectures right here, and we're going to continue the machine learning process for the next lecture video. Bye-bye.